Hello, everybody, and welcome to the Dorsey Wright podcast for the week of August 9th. I'm Jay Greg Nanny here. Joining me again this week is Ian Saunders. Ian, great to be back with you this week as we are continuing to move through and really in the midst of summertime here. A lot of people getting some final last-minute vacations in before school starting back for many people starting back towards the latter part of August, mid to late August for some schools like some of us here in the Richmond, Virginia area. We've got a couple more weeks to hang on to as schools are not starting back until after Labor Day. So a couple more weeks to get some of that vacation in. And, it's a couple more weeks for the market that as we continue to move through August, which, as we discussed last week, is the start of this stretch in the market that has historically been viewed as a weaker time period in the market, the month of August specifically being the month that has produced on average the worst return for the S&P 500 historically, going back to 1987, with September being right there, kind of towards the bottom of the list. Nonetheless, as we continue to move through the beginning parts of August, at least, we're doing so with an equity market as defined by a lot of the major indexes, but the S&P 500 that has been seemingly very, very resilient and has not cared that we've turned the page to another month, that being the month of August. It has seemingly been extremely resilient as well, just with a lot of the news out there, a lot of the uncertainty that continues to exist, and seemingly every day new concerns continuing to come out. Nonetheless, Ian, we're sitting here recording this on Monday the 9th, coming off of yet another all-time high for the market last Friday. And as we're recording this, the market, the S&P is doing its best to try and do that again and notch another all-time high. We'll continue to watch the market to see if that's able to happen. But it seems like, Ian, that we have, for a lot of days this year, we're 7 months through the year, and there have been a lot of days that we have said the market has hit yet another new all-time high, haven't there?
Absolutely, and it seems like almost every podcast we're coming into now, we're talking about how the market made another all-time high last week. And in looking at some of that data historically, we've actually seen that this past Friday, so the market, as you said, did hit that new all-time high on Friday after hitting it again earlier in the week, coming in on at least at the time of this recording, looking like we might hit another all-time closing high through the intraday movement this Monday, August 9th. But the Friday close, the Friday closing high actually marked the 44th all-time high that the S&P 500 has seen so far in 2021, which is the 10th highest number of all-time closing high days for the S&P 500 going back in any year going back to 1950. So definitely that kind of theme continued. And if we look at it, obviously we're only here through at the beginning of August. We look at it from a percentage of trading days standpoint. We see that the S&P 500 has hit an all-time closing high in just over 28% of the days so far this year. So closing in on a third of the days so far in 2021 that the S&P 500 has hit a new all-time high, all-time closing high rather, which actually sits second from a percentage standpoint. The only year that saw a higher I guess percentage of all-time closing highs was 1995, which saw it at that 29, or just over 29%. So definitely seeing that theme of all-time highs reflected in the data as well. But a couple interesting things to note. Generally, in looking at other years that have seen a significant amount of all-time highs, those all-time highs, perhaps unsurprisingly, generally tend to come at relatively overbought levels for the S&P 500. We see that that's not necessarily the case so far this year. So if we look at the 44 trading days that have seen the S&P close at an all-time closing high, the average overbought reading on those days is only around just north of 60% overbought from a weekly overbought over sold standpoint for the S&P 500. So while it is certainly in generally overbought territory, it's not what we would consider to be extremely overbought by any means. Other years that have seen significant levels, such as 1954, which saw 73 days where the S&P closed at an all-time closing high at an average overbought reading of 130%. So quite a while ago, certainly a different market environment. Back in 1995, that the most number of trading days in that year, seeing at 77 new all-time closing highs in 1995. Average overbought reading of about 86%. So a little bit higher than where we sit now. And I think, Jay, that brings up a few interesting points that you and I were talking about earlier. We've been seeing a fair amount of rotation underneath the hood, which has led to maybe some normalization in days when the market's not hitting an all-time high, right? And looking at some of the other indicators perspective that we can track, we still see generally strong participation across the board from a bullish percent perspective. So a lot of stocks in the S&P 500 sitting on in buy signals. Actually, that BP SPX chart sits at 68%, and even more sitting in positive trends. So longer term participation up at 82%. We've seen recently though the 10-week for the S&P 500, so the percentage of stocks in the S&P 500 that are trading above their 10-week or about 50-day moving averages, it does sit a little bit lower. So we're only sitting at a chart level of 62% as of market close on Friday. So we're seeing this kind of consistent, steady improvement, hitting new all-time highs at a relatively frequent basis. But that's not necessarily paired with everything kind of continuing to tick higher and hit all-time respective highs, and when looking at some of the individual securities, and certainly when looking at it from some of the sector perspective.
Yeah, specifically, it's all great points, and specifically as it relates to a lot of the market indexes. And you think about the S&P 500, and you think about what sector has the most importance or the biggest weight on the S&P 500. That sector is technology, and technology is really a group that for many years has been a leadership sector. It lagged a bit, really, the last quarter of 2020 and the first quarter of 2021. And it took a breather. There wasn't anything technically that really deteriorated with technology, other than the fact that if you look at a lot of the charts of individual technology names, they kind of just traded sideways for a period of time, 6, 8, 9 months, and in some cases, some of the individual stocks for a year. But you've really seen the resurgence and growth come back, specifically as it relates to technology this year. And while technology was underperforming in the first quarter of the year, other sectors managed to keep up, namely areas, a lot of the value sectors, energy being right there at the top of the list, which even is still, because it had such a big move earlier in the year, is still the best performing sector on the year, although I would suspect that to change in the next couple of days, just as energy in general has underperformed quite a bit here over the course of the past month or two. And you're starting to see other sectors that are continuing to move forward. Financials and real estate, interesting enough, are right there in number 2 and 3, and you very well could see those overtake energy from just a pure performance standpoint when we look at the market today. But really, those growth sectors, technology, communication services, those are ones that certainly have continued to move up the ranks along with real estate. And when you look underneath the surface and you see, basically the sector rankings, you see consumer discretionary has been one that's been at the top of the list for quite some time now. But technology, as it relates to the Dolly sector ranking, technology has recently moved back up to the number 2 position for the first time in quite a while you've seen energy fall out of the top half of that ranking for the first time really all year, seeing that happen just a few weeks ago. But if you look in terms of the most improved sectors of the market, I alluded to it earlier, real estate really has been the most improved area of the market, as you've seen that sector pick up the most net new buy signals as it relates to the Dolly sector rankings, and you're continuing to see that sector improve along with technology as it relates to the sector rankings. Again, the biggest movers to the downside as it relates to sectors has been energy really over the course of the past month. And so, while you're seeing the market hit new all-time highs, you're not seeing much in the way of deterioration or weakness as it relates to just broad indexes or broad indicators, but you certainly are seeing some rotation continuing to happen underneath the surface as the more growth-oriented side of the equation and real estate, specifically from a sector perspective, have really come back into favor. And we've certainly seen that not only in the sector ranking, but also beginning to see some of that show up in a number of our guided models.
Absolutely, and I think that one point that you touched on is that the general strength we're seeing from the core domestic equity space, right? The S&P 500 still obviously hitting all-time highs, still scoring very well, and ranking very well across the rankings. And we saw that reflected in one of the recent model updates that we saw that took place last week with the latest evaluation of the latest seasonal evaluation of our fund score method FSM models. So those models are evaluated on a seasonal quarter basis, which gets you outside of the normal calendar quarters and tries to capitalize on that idea of market seasonality, right? Sell in May, go away, come back in November. And so we evaluate those models 4 times a year at the beginning of February, May, August, and November. So we saw this latest evaluation take place as the market closed last Tuesday. Any corresponding trades were distributed Wednesday morning. And there weren't all that many changes in the latest evaluation, certainly not as many changes as we saw take place back in May of this year, but there was definitely some consistent themes to note, tracking with a lot of the conversation that we've been talking about this morning, namely that rotation back into the growth camp, back into the large cap growth camp, really specifically there, away from some of the smaller cap areas that had showed more improvement earlier this year. So definitely saw that movement back towards growth, back towards technology, now being the most overweight sector in many of the equity-focused FSM models that we saw there. And a couple interesting trades to take note of. One particular model that you can look towards there that's indicative of some of this recent movement we're talking about is the one that named the FSM Core Solution All Cap World 2S model. So that model takes an inventory of broad equity representatives. So not just US equities, has the potential for some international to come into play there, but all equity focused funds. And as with any of the models, it takes the inventory of funds, whether mutual funds or ETFs, in this case, ETFs, and ranks them by their corresponding fund scores at each evaluation. So in this particular model, looking to hold the top 2 funds by fund score. And in last week's evaluation, we did see a rotation away from value with RPV being sold from the portfolio and into growth with RPG moving into the portfolio, then Invesco Pure Growth ETF moving back into the portfolio. It joins the equal weight S&P representative, ticker RSP, as the two representatives in this particular model. So definitely see that tilt towards the large cap camp, and also now back significantly overweight growth with an overweight sector exposure toward technology in this particular model. Again, that theme was reflected in many of the other equity-focused model changes that we saw. Did see a couple models there pick up some real estate exposure, Jay. So it was interesting. You noted that more recent improvement from real estate. Saw a couple models pick that up. Definitely will be an interesting place to monitor as we move through the rest of the year here to see if real estate becomes more prevalent across some of the other models. We're talking this morning that it's been a while since we had broader real estate exposure across most of the models. So will definitely be an interesting point to continue to monitor there. But at least for the time being, certainly see the overweight towards growth, overweight towards large cap, away from some of the value, away from some of the small cap, was definitely the prevalent theme in this latest model evaluation.
Yeah, and that's, again, just to kind of reiterate, that is a lot of those FSM models are evaluated on a quarterly basis, that is a seasonal quarter. So it's not your typical end of March, end of June, end of September, end of December, but it's pushed by basically a month. So you're looking at the beginning of August and seeing a lot of those change, a lot of changes happening here recently, and certainly those trends of growth and as well as real estate are showing up inside of some of those models. And there's lots of different applications. If you're not familiar with the FSM models or the models on our website in general, lots of different applications. One of the initial uses of some of those FSM models was really designed to take a large inventory, specifically something that you might have access to inside of a client's 401k plan with mutual funds, and apply a systematic set of rules that can help guide the portfolio decisions over time without being overly trading and being cognizant and sensitive of, specifically as it relates to mutual funds, but just, general trading over the life of it and adjusting those portfolios quarterly. So evaluated them frequently enough to be sensitive to the market, but not letting them go a whole year without making any changes to the portfolio. So that was kind of the initial utilizations of them. There's a lot of different models out there that are, some are specific to provider inventories, some are specific to certain firms, 401k menus. We have one that we run on our own menu of options. That is certainly something that gets utilized by a number of people here, I know. So those are something to take a look at if you're not familiar with those FSM models or just generally looking for ways to implement those. Please don't hesitate to give us a call. But if you log into our website, click on the models page, that's where you'll see all of the information on those FSM models, as well as other models, ETF models, individual stock models that are out there as well. So with that said, as always, we appreciate you joining us this week. If there's anything we can do, please don't hesitate to reach out to us and let us know. You can reach us via phone, 804-320-8511, or if you'd rather send us an email as you're sitting on the beach, you can do that as well, dwa@dorseywright.com through the remainder of the summer, or as you get into the fall, those email and phone lines will certainly be open. So with that said, thank you again. Appreciate you taking the time to listen to us, and we'll be back on with you next week.